that is the closing bell on Wall Street, and now it's market domination overtime, giving you full team coverage of all the moves to get you up to speed on the action from today's trade. Head of research at Wall Street Horizon, a TMX company, we have Christine Short, as well as Yahoo Finance's Jared Blikre, joining us here to break down the moves today. Jared, let's start with you on that close.
Well, thank you. Pretty interesting close. We got 2 days in a row that the Dow Jones Industrial Average just barely squeaked out a win. We're talking about 15 points here. And let's just take a look at the intraday chart. Very choppy action, pretty low volatility. But the action has been in the Nasdaq. Not down as much as it was yesterday. And you can see we're well off the lows today, but still down about 2/3%. And just to put things in context, here's what happened over the last 2 days. A net down of about 2.08%. Taking a look at the S&P 500, I'm going to dial this back down to a 1 day, and you can see erased a lot of the losses from those lows, and it finished off the day down about 0.25%. Finally, the S&P 600, the small cap index, down about 0.5%. I'm going to skip over to the sector action, where we see a lot more green than red here. Leading the way down was consumer discretionary. A lot of retail names in there, including TJX and also Target, and also tech was down about 2/3%. And then the other underperformer today was communication services. So the bottom three here, all of those mega cap sectors, and you can really see this when we take a look at the Nasdaq 100. Lots of red, not a lot of dark red, but red when we take a look at the bigger names here. If we sort by performance, we see probably about 2/3 red. Leading the way down, interesting, is Intel. That was leading the way up yesterday, down 7% today, and you can see it's net down about 0.5% over those 2 days. I'm going to skip over to the Dow here. You can see a lot of green on the right side of the board there, so a lot of the smaller names doing a lot better than their mega cap counterparts. Caterpillar, a standout to the upside, up about 1%, and Travelers up about 2%. Also Walmart up over 1.25%. Also, I'm going to take a look at the transports here, because that had been a bright spot yesterday. Not so much today. Uber down 1.5%, FedEx down 2.5%. Airlines not doing great. Looks like American down about 3%. So kind of a mixed day when you take a look at all of the scoreboards here, and just kind of closing on the leaders. Cannabis and Bitcoin, they did well today, along with the oil trade. And home builders, they led the way down. They were one of the leaders yesterday. So more rotation, more switching of places, just a lot of sideways action in the indices.
All right, thank you, Jared. Christine, I want to get you in here. Your thoughts on today's trade. Christine, what'd you make of it?
Yeah, I don't find it so surprising that investors are taking some profits here, right? You had an earlier guest that talked about the valuations of some of these names, and they've gotten pretty rich, right? So you're seeing tech stocks take a little bit of a breather here. A lot of them since the April 8th lows, the S&P 500's tech sector specifically has just run, I think it's, even given today's and yesterday's route, still up 48% over that time versus the overall index, which is up about 28%. So 48 versus 28. So you see how those tech stocks have run, taking a little bit of a breather here. But overall, the fundamentals we saw from the earnings reports were stellar. We've got NVIDIA on deck next week, I think on Wednesday. I think that'll be the next catalyst higher. But again, I'm not overly concerned. Yes, the valuations are rich, and I think you see some investors kind of reevaluating that in the face of what were very good earnings over this last season.
Longer term, Christine, you still think it looks like a favorable setup here for equities into year end?
Yeah, going into year end, the S&P 500 always performs really well in November, December. I think you see just taking out the last 2 days, but tech momentum has been there. And I think there's a couple of great things going for them. One, as I mentioned, the earnings and the fundamentals have been very strong. And then you also look at the IPO market, and that's really what's been leading money into VCs putting money into IPOs and public debuts once again, have been those AI, those crypto names. And so I think you've got a favorable setup coming into the end of the year. Again, I think NVIDIA next week will be a catalyst to the next leg of this.
Do I even need a Fed cut to move higher into year end?
I don't think you do, because I don't, at certain points of the year, we weren't even expecting one. Certainly that would be the favorable outcome is for a September cut. But as the prior guest already talked about, we've gotten sort of ahead of ourselves on how many cuts to expect. But again, I think the baseline case is still there. The AI revolution, Dan Ives over at Wedbush always says we're at the top of the second inning. We have such a ways to go. And the investments, you've seen the CapEx spending that some of these mega tech companies are putting into AI. I think that's all very favorable. favorable
just
setup.
remarkable spending we heard from those big tech on all things AI CapEx.
Absolutely.
Yeah, for sure. All right, Chris, let's get more perspective on here because you did see stocks close the day mixed. Dow eking out a gain. Nasdaq still feeling the heat from those losses in the tech sector. Joining me now is Jeff Palma, Cohen & Steers Head of Multi-Asset. Jeff, it is good to see you. Well, let's start with the action we're seeing in the broader markets, Jeff, and tech lagging again. I'm curious what you make of that, Jeff. Is that just a hiccup, or do you see the start of something more meaningful? What are you telling clients?
Hey, Josh, I think it's always a little hard to tell in the middle of August exactly where markets are headed. This does have a little bit of a feel, though, a lot like the first quarter of the year did. If you remember, feels like a long time ago. A lot's happened since then. But tech and the broader equity market actually underperformed things like international equities or other parts of the market. And so, it might just be those numbers that you were just citing before with Christine, kind of talk about the massive rally that we've had in tech. Valuations have kind of moved to levels where people are a little bit more concerned. And it might just be that people are looking around for other better opportunities at this point.
You mentioned valuations there, Jeff, which is interesting because on this show we've had a bit of a debate. I've had some strategists say we are, broadly, we are stretched and it makes them uneasy. That's the word they use, uneasy. Others, and I had a strategist, an investor on this week who said, valuations are broadly stretched. Her opinion was, you know what, we deserve to be stretched. It's justified given the earnings growth we're seeing. How do you come down on it?
Well, there's that saying that valuations are never a catalyst for a move, or at least rarely a catalyst for a move. I think, the way I guess I put it is, at these sorts of levels, it doesn't mean the market has to fall today, but there's an awful lot of good news baked into prices today. I think we came from a level earlier this year where there was a lot of concern about growth. There was concerns about tariffs. Those have, very much fallen to the wayside at this point. We're now talking about Fed rate cuts and, other sorts of catalysts. And of course, we've come through an earnings season that's been really, really supportive. I think in the fullness of time, though, it is harder for broader equities, we would say cap-weighted equities in general, to sustain these sorts of valuations, or at least for them to move higher. That at least kind of puts some sort of a ceiling on the ability for kind of broad equities to outperform other asset classes like real assets and so forth that we've been focused on over a more sustainable period.
Christine, your thoughts on valuation. Broadly, you agree, Christine? You think we've priced in a lot of good news at these levels?
Yeah, a lot of these names are certainly priced for perfection, but as we've all talked about, the earnings did come in at a level that many investors felt justified some of those valuations. And if you look ahead to the third quarter, analysts have actually taken estimates for the S&P 500 earnings growth up, and one of the main leaders are the tech communication services. So they're still seeing strength there. You don't often see analysts actually go halfway through the earnings season lifting estimates for the next season. So still some really big expectations going into the back half of the year.
Jeff, given the backdrop here, the environment we find ourselves in, bottom line, Jeff, where are you seeing opportunity? What are you telling clients?
So a couple things at this point. So number one is I think it's really important that growth continues to hold up. Overall GDP growth has been fairly mediocre, but that's certainly translated through into earnings. I think one, that has to continue. Number two is for us, and I think it's really important, it looks like inflation is bottoming, right? Even before some of the impacts about tariffs and so forth have really come through. We think inflation is likely to accelerate a little bit. That puts a little bit of pressure to the upside, we think, on interest rates from where we are. And real assets, we think, should do really well. So the assets that are kind of sensitive to underlying inflation pressures, things like global infrastructure, real estate, natural resource equities, and commodities, we think is probably a great place to be over the balance of this year, but then also into next year as well.
So those real assets, Jeff, real estate, infrastructure, commodities, are there certain common variables between those three, Jeff, that you think tie them together and make them generally poised here for stronger returns?
Yeah, so I'd say a couple of things. Number one is real assets generally are sensitive to higher inflation, or at least they perform a little bit better when inflation has some pressure to the upside. I think another common factor here is the starting point on valuations in all of those markets is far more attractive in our view than broad equity markets. They've certainly lagged over the course of the last couple of years, not so much this year. But that starting point on valuations at a time when we think inflation stays sticky and there's sort of broader pressures on things like commodity prices and so forth, really kind of bode well. I would add for markets like infrastructure actually does have a play into some of this technology discussion that we've been having, that is things like power demand and so forth. So those aspects all make a pretty good story at a more attractive valuation, in our opinion.
Christine, what do you think? Real assets, the place to be?
Yeah, like Jeff said, if you're looking to protect against higher inflation versus some more sensitive areas, assets like stocks and bonds, things like real estate, infrastructure, commodities seem to make more sense. If you do think inflation is going to get worse as we see tariffs unfold, that's certainly an area of consideration.
Jeff, great to have you on the show. And Christine as well. Thank you for joining us for the full hour, Christine. Appreciate it.
Thank you so much for having me.
Federal Reserve Chair Jerome Powell's upcoming speech may be worth its weight in gold. And the actual commodity gold is advancing as traders weigh the outlook for monetary policy. Let's bring in senior markets reporter Inez Ferre with the very latest. Inez.
Josh, that's right. And traders are awaiting for Fed Jerome Powell's speech to hear where the Fed is going to go in September, whether there will be a rate cut of 25 basis points or 150 basis points. But look, gold right now is up year to date 27%. That's on a strong structural demand from central banks and also strong inflows into ETFs. As far as what the banks are predicting for the next few months, you have UBS that says that gold will head back towards the April highs of 3,500. We're only off about 100 and some odd dollars from those highs, but that would be the London spot price, of course. And then also you have Goldman Sachs that's predicting that gold is going to head to 4,000 by mid-2026. And what they're saying is Fed easing, that's supposed to be bullish for gold because of gold is a non-yielding asset. But also with respect to the downside risk, they're saying that if there is a peace agreement with Ukraine, then you could see gold going down down by about 3% if that peace agreement takes place. However, you still have the structural strong demand from central banks. And what they're saying is that after Russia invaded Ukraine and Russia's assets were freezed, that's when central bank demand really accelerated. And they don't see that stopping anytime soon.
All right, Inez, thank you.
Thank you.
Officials are reportedly eyeing stakes in other chip makers besides Intel. It's according to reports from Reuters. Gautam Mukunda, lecturer at the Yale School of Management, along with Technalysis research chief analyst Bob O'Donnell, spoke to Yahoo Finance on the potential partnerships between chip makers and the U.S. government and what this could look like. Take a listen.
I think it's going to be pretty hard to convince TSMC and other companies from outside the U.S. for some of these deals. But so, I mean, it's going to be Micron, there's Global Foundries, there's TI to some degree, although they got a much smaller amount. So, I mean, I think that's probably where it ends up. But look, I mean, the bigger issue that we have to be talking about is this really the right thing? I mean, the government has given subsidies to farmers and to all kinds of other industries, and there's never discussions of payback and investment there from an earnings perspective. And I think it raises some very serious questions that we need to be thinking about because there's potential long-term implications here that I don't think are very good.
On that front, I was struck by a column from Greg Ip in the Wall Street Journal that was out about 10 days ago, even before this latest round of talk about Intel. And he wrote, a generation ago, conventional wisdom held that as China liberalized, its economy would come to resemble America's. Instead, capitalism in America is starting to look like China. And Gautam, I want to bring you in on that. Companies don't seem to be raising a big ruckus here because those that have gotten, sanctioned in various ways, right? So how do you think this will work between the government and Intel or whoever else?
Yeah, companies are objecting because they're afraid. Like, it's really just that simple. And CEOs of major corporations think of themselves as some of the most powerful people in the world, and in many ways they are. But if you compare even the most powerful CEO of the biggest company in the world to the president of the United States, you're comparing a pygmy to an elephant. There's just not even a competition. And so this is a president who's demonstrated over and over again that he's willing to use the powers of the federal government, even illegally use the powers of the federal government, to punish people who he doesn't like and who disagrees with, or, on a whim. And CEOs individually are all saying, look, I can't play that game. Collectively, they might be able to stand up to him, but strikingly, the organisms of collective action, the Chamber of Commerce, the conference board, things like that, are just not standing up and acting as organizers to get CEOs to rally together and use their strength collectively.
Well, it seems like in part, Gautam, it's because maybe they're getting some benefits from this as well, right? In the case of Intel, yes, it got that $2 billion infusion from SoftBank, but if it does strike this deal with the government, is it more of an advantage than a disadvantage?
Intel clearly has had some troubles over the last few years, but I don't think they're so desperate for cash that they need this $10 billion from the government, when what you're doing is essentially letting Howard Lutnick and Donald Trump into your boardroom and allowing them to dictate the future course of the strategy for your company. They're making claims about they're going to be non-voting shares, but nobody believes this, right? It's completely implausible. And so even apart from the national level issues where the federal government is not capable of administering this, doesn't have these abilities, none of these things make sense. From an individual level, being the temporarily fostered patron of the Trump administration might be good for a week or two, but I think Lip Bhutan knows better than anybody, right? That a few weeks ago, Trump was calling for him to be fired. Now he's the favorite child. Next week it could be something else, and no company can be run like that.
Bob, what do you think here? Because you've said also that Intel is essential to American security. So there is that sort of argument to be made that this is in the national interest to build this strong homegrown chip industry.
It absolutely is. And I completely agree with what was just being discussed, because look, these changes all the time are just untenable for long-term success. And when we think about the critical importance that semiconductors play in the entire economy, we always talk about it being tech, but remember that semiconductors are in cars, they're in washing machines, they're in pretty much everything. And all of those things are driven by technology advancements. And right now, the most advanced technology in the US is made by Intel. And they've been making these investments to enable other companies to leverage them, because not only are there geopolitical issues, there's just the basic practical issue that you've got one company, TSMC, that owns essentially almost 100% of the most advanced chip making, manufacturing capacity. That just doesn't make any sense from a supply chain perspective at all. You need diversity. You need manufacturing in the US, because semiconductors are going to be critical moving forward. You can't just take another company and say, oh, well, you can be the next Intel. There have been decades and decades of work done to get to where they are. These things don't change overnight. So I think it's essential that the government does provide some subsidies. Maybe they encourage other U.S. companies to work with Intel. That's the piece that Intel needs for their foundry business to really move forward, to nail, an NVIDIA, an AMD, an Apple, a Qualcomm, these kind of companies to do some work with Intel in their foundry business. That could really turn things around, and then start to see a more diversification across the supply chain, which is really essential, again, not just for the US, but for the global semiconductor industry.
So, Bob, just quickly then, do you think that, it sounds like you do think there's a need for the homegrown industry. What else needs to be done to accelerate and expand that process?
Well, like I said, there are other factories we have here in the U.S. We want to see more focus on companies like Global Foundries, obviously Micron, but Micron specific because they're doing memory. Global Foundries is also limited because they're not doing the most cutting edge process, but they're doing very important work. And so if there's anything that could be done, it would be, hey, why not provide monetary incentives from the government to U.S. companies to say, look, we're going to encourage you to invest in U.S. companies. Because, for example, Lisa Su from AMD said even buying chips from TSMC made in the U.S. is going to cost more than chips made in Taiwan. So maybe the government covers those kinds of differences to encourage these companies financially to make those investments. So that's the kind of developments I would like to see, and I would hope we would see something like that moving forward.
Time now for To Watch Thursday, August 21st. We're going to start off on the earnings front. More reports from the retail sector coming in on Thursday, including Walmart and Ross. Walmart announced results for the second quarter before the markets open. Analysts expecting Walmart sales to rise in Q2, driven by price rollbacks and consumers hunting for value amid the current inflationary environment. Moving over to housing, we're going to be getting some fresh housing data with existing home sales for July. Economists forecasting sales to fall slightly to an annualized rate of 3.92 million, suggesting no significant change in the sales pace. And taking a look at the Fed, more commentary coming on Thursday from Atlanta Fed President Raphael Bostic. This is coming as the 2025 Jackson Hole Economic Symposium kicks off on Thursday. Yahoo Finance will have coverage from Jackson Hole, including interviews with Kansas City Fed President Jeffrey Schmidt in the 10 a.m. Eastern hour and Cleveland Fed President Beth Hammack at 11 a.m. Eastern. Well, that's going to do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell. But don't go anywhere. On the other side of the break, it's asking for a trend. We've got you covered for the next half hour with the latest and greatest market room stories so you can get ahead of the themes affecting your money. Stay tuned.